What's up everyone, it's Arnold here. Hedge funds, the big baddies of 2021. They are a powerful force in the market. They have the ability to move millions, billions, and drive stock prices up or down. But what exactly are they? Who are they for, and what exactly do they hedge? We're going to talk about all of that today. What are hedge funds? Who are they for? And some of the controversies that surround it. So let's get started. So first of all, let's talk about what exactly are hedge funds. So hedge funds are an actively managed pool of money. Essentially, you give these people your money and they invest it for you, oftentimes using advanced risk management, portfolio selection, or trading techniques. Examples include short selling, derivatives, and leverage. It's regarded as an alternative investment, which means anything that's not stocks, bonds, or cash. Examples include anything from wine to art to rare postal stamps to, of course, hedge funds. Well, this all sounds pretty great. You might ask, where do I sign up? Well, hedge funds are generally reserved for those that are extremely wealthy. People that make over $200,000 per year or have a combined net worth of over $1 million, excluding their home or primary residence. And this is because the SEC restrict hedge funds to these high net worth individuals. Essentially, their thinking is that if you're smart enough to make this amount of money, then you must be smart enough to understand the potential risks of investing in hedge funds. Usually, hedge funds require a large initial investment, think tens or hundreds or millions of dollars. And there's a lockup period where you're not allowed to take any money out of a hedge fund. Generally, this is 1 year. After the lockup period, you can take your money out on a quarterly or annual basis. So what do hedge funds do? You might ask, what do they hedge? Generally, each hedge fund follows a specific investment strategy. Maybe their strategy is to short failing companies they just don't like, so they bet that the stock price will go down. But what's more common is called a long-short equity strategy. So what this means is that they'll invest in what they regard as winner stocks. They do a sort of analysis to determine what is going to succeed in the future. And then they short what they regard as loser stocks. These are stocks that, through analysis again, they might determine that it's not going to do well in the future. So by investing in winner stocks and shorting loser stocks, they have a net market exposure of 0. So as long as their analysis is correct, they'll make money as long as their winner stock outperforms the loser stock. And this is what happened with GameStop. A lot of hedge funds shorted GameStop because through their analysis, they determined that GameStop is not a winner stock, and they probably invested long positions in bigger companies such as Apple, Google, your FANGs, or any sort of winner stocks they determine. But this does not mean the hedge funds only invest in stocks. They can really invest in anything that ranges from real estate to land to currencies, and it's really limited only by its investment strategy and the hedge fund's mandate. This is contrasted with mutual funds, which are more accessible to you and I, but they generally only invest in stocks or bonds. So this is the juicy bit. What are the controversies with hedge funds? Well, the one that comes to mind is the great short squeeze of 2021. As I mentioned, a lot of hedge funds determined that GameStop is a loser stock, so they shorted it. The murky bit is that they likely had backroom conversations where they discussed with each other their long and short positions, and they can collude essentially and manipulate the market price such that they'll drive the stock price of GameStop lower to their advantage because they shorted the stock. This is probably not done explicitly. This is probably in some underground club in New York City that only they are privy to. And this is the whole reason for the Wall Street Bets movement. This is where retail investors could come together in these backroom conversations that's accessible on the internet and do what these hedge funds have been doing for a long time: drive the stock price up or down by having conversations amongst themselves. And that is why the movement was so powerful and so many people were behind it. Not just the fact that they were making money and making GameStop go up, but also the fact that they're sticking it to the man. They're taking the power back to the people. Other controversies include insider trading. So in 2008, there was a backroom conversation between a board member of Goldman Sachs and a hedge fund manager. The board member of Goldman Sachs told the hedge fund manager that Warren Buffett was going to make a large investment in Goldman Sachs. So the hedge fund manager decided to buy a position in Goldman Sachs, and then once the news that Warren Buffett was going to invest in Goldman was made public, the hedge fund made a lot of money. But luckily, this hedge fund manager was convicted of insider trading, not just in this instance, but in many other instances in the past as well. So it goes to show how prevalent these issues are. So in conclusion, hedge funds are complicated. Because of their investment strategy and the money behind their funds, they're able to move markets. They're the driving force behind much of the market movement. The good thing is that the internet is democratizing this power and bringing this power to retail investors, people like you and I. So hope you learned something today, added some context to these stories that have been happening for these past couple of weeks. If you like this content, feel free to like and subscribe to this channel and share this with anyone else that you might think would find this helpful. I'll see you in the next video.